Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Thanks for joining us. Well, today we're talking about the apartment market. You know, the apartment market has been hot. Some people are wondering how long will it last, and it's been great. Well, we'll find out today. First, we're going to talk to Ron Jonesy about the market and the sector, how it's doing, how it did last year, what to expect. And then we're going to have a panel that's going to get us behind the curtain a little bit. Well, first, please welcome my first guest, Ron Jonesy, CEO and president of AxioMetrics. AxioMetrics provides apartment data and apartment market research in the U.S. Ron, thanks for joining us today.
Glad to be here, Michael.
Well, Ron, thanks. And how did the U.S. apartment market perform overall last year in 2013? Did it slow up any?
Yeah, it sure did, but it's still a good number. We think rent growth is about 2.8%, but it's down from 3.6% in 2012. And if you look at the peak, you know, we had a trough in 2009, and then by 2011, at the U.S. level, rents were growing at almost 5.5% rate.
Wow.
So the rate of increase has slowed down, but an interesting thing also happened was the occupancy rate ticked up. So we had the occupancy rate tick up by 30 basis points. So it's always great when you have a market where you can still increase your rents, even though it's a slower rate, but your occupancy rate is going up. So it's a very positive sign. And the thing to keep in mind is, in our database, the long-term average, effective rent growth is about 2.2%. So we're still above, that long-term average. And what drives that rate down, of course, is, we had a couple of recessions in there. But these numbers are, regression to the mean type numbers, and they're not bad.
Right, 2.8 rent growth with increasing occupancy. That's really still a great number, isn't it?
That's right. And, the U.S. only produced about 2.3 million jobs. And so job growth still been anemic, about 1.7%, really poor anemic job growth. And it sort of gets into, in your intro, you were talking about, the demographics, what's really driving this market. Mm-hmm. And you have to look at the millennials and the echo boomers that are coming of age, and you have this wave of kids that are looking, college-educated echo boomers that are hitting the market. And I really believe if you look at when they move into graduate from high school, move into a student housing on a college campus, they may stay renters for almost 20 years. And the reason why is the age of first marriage is getting pushed out to 26 or 27 years of age, and then they may have a child, and that may cause them a year or two later. So we were really bullish on the apartment market for the long haul. But let me just look at 2014 and tell you what we're thinking is going to happen there. 2014 is going to be about the same as last year, about 2.7% effective rent growth. And the occupancy is going to fall. It's going to go down slightly to 94.3. And the reason why is we're seeing more inventory growth. It'll increase from like 0.9% of the stock to about 1.4. And job growth, we're still saying is going to be anemic. There's so many headwinds in this economy that are, really going to keep, I think, job growth and the economy from taking off. But on the other hand, if the economy does take off, these numbers would be a lot better.
That's amazing. And it's also amazing how much the demographics are really affecting the market. I think some people looking at the apartment market from the outside may have thought, well, this can't last this long, but the demographics are there. That's what's really supporting it. That's amazing. And how do you expect the market to perform for A versus B or worse than B product? I know the A market's doing well. What about B and the rest?
Well, there's typically a dance, and what we've seen is the A's, increase their rents the quickest, the earliest in a recovery and race ahead. And as they keep pushing those rates, renters will opt to move, control their housing costs. So, if you're paying $1,000 a month, you may say, I'm not going to take any more increases, but I'm going to look for something else in this neighborhood for about $1,000. So then they may move into a B. So the B's start to get fuller, and it goes all the way down to the C's. What we're seeing right now is that Class A in 2013 had rent growth about 3.2%, but the Class B outgrew that at 3.5, and Class C was 4%. So going into 2014, we expect Class A to rent growth to moderate to about 2.6%, Class B about 3.2%, and Class C 3.5%. Now, what's driving this is the supply. In our modeling, we think that there's going to be an oversupply situation in 2014 and 2015, and because of that, there's a lot of pressure on Class A pricing.
Well, that's interesting. So you think there may be some overbuilding beginning to happen in some of these markets?
Yes, I do. But here's the other thing. We're starting to see starts slow down. Mm-hmm. And the reason why is you've got construction costs are going up. You've got Class A and you've got material and labor going up. And then you've got Class A rents declining, which is going to make it more difficult to drive Class A rents and start new projects.
Right, that's a good point. And we're talking to Ron Jonesy with AxioMetrics about the apartment market. And Ron, you also mentioned housing and people maybe buying houses later. You know, the housing market is improving. Interest rates are still low. People are starting to see increases in home values. How might home sales in that market affect the apartment rental market?
I really think, well, first of all, we need a strong single-family housing market. New housing production is very vital to the economy. It creates jobs, which in turn helps the apartment market. Mm-hmm. If we get back to a situation like we had in the mid-'90s where, let's say, total production was around 1.4 million units a year, the apartment market did great back in the mid-'90s. I think we'll be back in that situation. You know, we'll get typically an apartment have move-outs to home ownership in the 15 to 18% range each year. That may be substituted for move-outs to rent a home, but I just don't think it's going to get above the long-term, turnover rate. And you've got to buy a house, you've got to have, like at least a 720 FICO score. You've got to have a down payment, maybe as little as 5%. I understand now, but these college-educated echo boomers, they've got college tuition debt. They got credit card debt. They don't have the FICO scores. It's a lifestyle decision. So I just don't see it being an impact at all. But we want it to come back because it helps the overall economy and helps the apartment market.
Right. And the qualifying for new loans, that's a good point. So it's no longer the breath test that we had in the pre-recession days, right? If you could fog a mirror, you were approved for a loan.
Oh, it was totally ridiculous, yes.
Yeah, and you talked about some overbuilding in some of the markets. What are some of the markets that are struggling?
Well, the markets that are struggling are going to be, the D.C. market, and that's no surprise. Their effective rent growth has gone negative. Raleigh is another market that is hurting somewhat, and as well as Baltimore. But the other markets to watch out for depend upon really strong job growth, and those are markets that they're really no surprise to anybody. It's the Dallas, the Houstons, the Austins, the Seattles, and Denvers of the world. And when you look there, you're really depending on job growth to absorb all that supply because there's some very substantial increases. Like in Dallas, supply is going from 10,000 to 12,000 in 2014. Houston's going from 8,000 to 15,000 units. Austin is going from like 6,000 to almost 10,000 units. So there's huge increases that really depends upon, job growth to take care of that supply.
Well, Ron, let's talk about opportunities. I mean, you're tracking this market all over the country. So if I have $10 million and I'm going to buy some Class A apartments, what are some markets that are showing some signs that it might be a great place to buy?
I really think you ought to look at Atlanta, right there, your hometown. Mm-hmm. Atlanta was a late recovering market, but now it's starting to take off. And what drove the metrics in Atlanta to look poorly was the Class C. The Class C occupancy rate was so low, the rent growth was so low that it dragged down the overall reporting for the market. But you had some sub-markets there where you had some double-digit increases in Class A properties. So I think there's a lot of upside in Atlanta. Same thing in Phoenix. Phoenix has really come back. It's going to have really strong job growth this year. And with that, there's more demand than supply, and so there's a lot of upside, I think, in those two markets in particular.
All right, well, that's amazing. Well, there's a good opportunity out there. I like the demographics. It sounds like the apartment market's still strong. Ron, thanks for joining us today. We really appreciate you being on the show again.
Thanks for having me, Michael. Really appreciate it.
Thank you. And if you like more from Ron, visit AxioMetrics.com. commercialrealestateshow.com. They've got some great information. If you're looking to invest in apartments or you own apartments, check them out. Great information there. Well, stay tuned. In just a moment, we're going to have an expert panel in here, and we're going to get behind the curtain, if you will. We're going to talk to some owners, brokers, developers. You're going to see what's happening and why it's happening. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.